Welcome to Skiller Learning. In this video, we will cover top 15 must-know finance manager interview questions. Question 1. Let's say your company's revenue has increased by 20%, but profit margins have dropped. What's the first thing you would analyze? The correct answer is cost of goods sold, COGS. As a revenue rise with shrinking margins often points to increased variable costs. Reviewing COGS helps identify inefficiencies in production or sourcing. Question 2. Imagine your CEO asks for a quick cash flow improvement. Which action would you consider first? The correct answer is negotiate faster customer payments. As improving working capital through receivable acceleration strengthens cash flow without adding debt or harming relationships. Question 3. If the finance team reports frequent reconciliation errors, what's the most probable root cause? The correct answer is outdated accounting software. As old or incompatible systems often cause mismatched data, leading to reconciliation issues. Question 4. How would you handle a situation where the CFO disagrees with your financial forecast? The correct answer is request a joint data review. As a collaborative review ensures alignment and data transparency, showing professionalism and analytical maturity. Question 5. You notice consistent delays in financial closing every month. What's your first step? The correct answer is review process bottlenecks. As process analysis helps identify whether delays are due to data entry, validation, or communication issues. Question 6. If your audit trail reveals missing supporting documents for expenses, what's your action? The correct answer is request document re-verification. As ensuring every expense has backing documentation maintains compliance and audit readiness. Question 7. Your company's debt-to-equity ratio has risen sharply. What might this signal? The correct answer is excessive borrowing. As a higher debt-to-equity ratio often indicates dependence on debt financing, raising financial risk. Question 8. If a project shows a positive NPV but low IRR, what does that imply? The correct answer is the project adds value but yields modest returns. As positive NPV means it adds value, but low IRR suggests it's not the best return among options. Question 9. A supplier offers a 2% discount for payment within 10 days, otherwise net 45. Should you take it? The correct answer is yes, it offers an excellent annualized return. As such discounts often translate to over 30% annual savings, far better than most returns. Question 10. If your finance dashboard shows increased inventory but stagnant sales, what risk emerges? The correct answer is liquidity risk. As high inventory ties up cash, leading to liquidity strain and possible obsolescence. Question 11. Which KPI best measures your ability to meet short-term obligations? The correct answer is current ratio. As the current ratio assesses liquidity by comparing current assets to liabilities. Question 12. Your department exceeds its annual budget by 8%. What's your first move? The correct answer is investigate variance causes. As variance analysis helps identify whether overspending was due to forecasting errors or operational inefficiency. Question 13. If your cash flow is positive but net income is negative, what could be the reason? The correct answer is overstated depreciation. As non-cash expenses like depreciation can lower net income while cash flow remains positive. Question 14. Your team struggles to meet compliance deadlines. How would you improve it? The correct answer is implement automation for tracking, as workflow automation enhances accuracy, accountability, and compliance adherence. Question 15. You're reviewing a cost center that consistently underperforms. What do you check first? The correct answer is cost allocation method, as misallocated shared costs can make a cost center appear unprofitable. For more such videos, please like and subscribe our channel Skiller Learning.